Welcome back to the channel, everybody. My name's Taylor and thanks for tuning in. Today I'm going to be telling you about the piece of a financial plan that you might have never heard about. This often overlooked strategy is something that the wealthiest people never pass up on, but you'd be surprised how many people have never heard about it or fully understand it if they have. In fact, because it's relatively new, I'd bet that a lot of the more traditional financial advisors have not even warmed up to the idea yet. It's a little bit nuanced, but don't worry, I've done all the homework for you. So grab your caffeinated beverage of choice and let's dig right into it. But before we do that, don't forget to click the subscribe button, hit the like button, and click the little notification bell so that you get notified every time I post a new video. The content is going to be ramping up here soon, so you're not going to want to miss it. Now, let me start by asking you a question. If I told you that you could invest money into the market with zero chance of ever losing anything, who's the first person you would call to borrow money from? What's that, son? You need a small loan of $1 million? Taylor told you to do it? Absolutely, he knows what he's talking about. Now, I say that half jokingly because obviously if that was the case, you'd just plow as much money as you could directly into whatever I told you to, because why wouldn't you? You've got no downside and only upside. What if I told you that if you start at age 20 and put $100 a month into account X, we'll call it, that by the time you're at retirement age, you could take a tax-free salary of over $30,000 per year indefinitely without ever having to worry about the account drying up? For those of you that are fairly quick with numbers, you probably already figured out that that means you start at age 20 and you quit at, say, age 65, that you're only putting about $54,000 into it over the course of that 45 years. But somehow that creates something that you can withdraw $30K a year from? How would that even be possible? See, in the past, it was believed that you needed at least $750,000 invested, earning 4% a year, in order to withdraw $30,000 per year from. That's if you don't want to worry about depleting the account. You want to live off the interest that the account earns, not the actual account. See, this is what's known as the 4% rule, which has become a standard over the years as a rule of thumb for knowing how much money you need saved and invested by the time you want to retire in order to live off the interest that that account earns so that you never have to worry about running out of money. To put that simply, if you're making $40K per year right now and you think you want to retire with the same amount of income, you need at least $1 million invested in order to feel comfortable that the money that you're withdrawing every year is going to be offset by the growth that the account sees each year. Remember, we want to live off the interest that the account generates, not the actual account. Now, what if I told you that that 4% rule that I just explained is a bit outdated and that you can actually set up your retirement in a way that you can withdraw between 10 and 15% per year without ever having to worry about running out of money? Would you be interested? Now introducing the Indexed Universal Life Insurance Policy, or IUL for short. Now, before you write this off, click off the video and never come back, just hear me out, okay? This provides some pretty big benefits compared to the alternatives. Now, I'm not saying you should put all of your money into this and nothing into the stock market. By all means, keep investing in the stock market, but having this as an alternative is going to give you more options when you get to retirement in the case anything goes awry. So just a little housekeeping here. When you purchase life insurance, you've got a couple options. You can buy term or you can buy permanent insurance. Indexed Universal Life Insurance is a permanent insurance option where it provides you a permanent death benefit, but also includes a cash value. The cash value could be considered your living benefit. You've got a death benefit and a living benefit. The money that grows inside that cash value can be tied to one or multiple market indexes in order to generate a return over time. When we buy an IUL, what we're essentially doing is getting some life insurance and investing the money that's inside it. Hashtag not sponsored. So let's talk about some of the features. You pay a premium to the insurance company to cover the cost of the insurance. This can be paid monthly, quarterly, or annually. There's a death benefit, which is the amount of money that's going to be paid to your beneficiary in the case of your death. The beneficiary is designated by you when you purchase the insurance policy. Any premium that is paid in excess of the actual cost of the insurance will be contributed towards your cash value. This is money that you can withdraw or borrow from anytime you need to, and a lot of people will structure this in a way that they can draw retirement income from later down the road. I'll paint that picture a little bit later in the strategy section of the video. The term universal in Indexed Universal Life pretty much just means flexibility. It's flexible on the premium that you pay and flexible on the death benefit. That means that if you want to pay a little bit more in one month, maybe you got a bonus at work, and then you want to skip the next month whenever money is tight, you have the freedom to do so as long as there's enough money in the cash value to float the policy for the time that you don't pay it. The cost of insurance for the months that you don't pay will simply be pulled from the cash value, and you won't have to worry about it as long as the cash value is there. Your cash value grows based on premium payments and market index returns, which means that the more you fund this policy, the faster your cash value will grow. Now, because this is a flexible policy, you can actually fund more into your premium payments in order to force your cash value to grow quicker. Now, there are maximum funding limits that are tested based on the death benefit and cash value accumulation. We're not going to get into the testing in this video, but all you really need to know is that you can only overfund the policy so much before they make you increase your death benefit. So essentially, there's a target premium and a maximum premium that you can pay each year. Again, because it's so flexible, there might be a situation in which you can overfund the policy a whole lot in the first few years, but then you might have less funding available in the subsequent years. You can set it up to pay it all in 5 years or 10 years. You can pay it for 30 years and then quit paying altogether. As long as there's a cash value, the policy will stay afloat. Now, the point of this video is to get into the weeds a little bit about how the cash value works, so let's do that. As I mentioned, it can increase based on the performance of a market index. So let's break that down. Most of these indexing strategies will include what's called a floor rate. This is the least that your cash value can be credited in any given year. Most of the time that floor rate is going to be 0%, which means if the market drops by 50, 60, 100%, your cash value is going to be the same as what it was the year prior. Now, because the insurance company is protecting you from any market losses, they're going to cap the upside that you can participate in. This is what's known as the cap rate. This is the maximum percentage that your cash value can grow in any given year. No matter how much the market index increases, you can't go over your cap rate. The cap rates are usually fairly high. It depends on what index you're tracking, but usually it's going to be double digits. Some market indexes might not have a cap rate, but they'll have what's called a participation rate. This means that the percentage return of that index will be multiplied by another percentage before it's credited to your account. It's pretty common for these participation rates to be more than 100%, especially on some of the safer indexes like a dividend index. Usually the S&P 500 will have a cap rate, while something like a dividend index will have a participation rate of 120 or 140. Some IULs will have additional bonus features or enhancements in the crediting strategy for your cash value. This bonus would usually look like an additional percentage boost to your indexing credit at the end of the year. For example, I'm in a strategy that gives me a 40% multiplier bonus on my index at the end of the year. So let's say the index returns 10%, I get credited 14%. Now obviously this could get really nice in situations where you have a high participation rate and a multiplier bonus. So just consider having a 140% participation rate and a 40% multiplier bonus. That means if the index returns 10%, you get 140%, which is 14%, and then an additional 40% bonus on that, giving you 19.6%. Are you starting to catch on why indexing is so good? If you're not catching on yet, let me describe some of the reasons why somebody would want to use something like an IUL. The growth somebody gets in this type of strategy is going to be much more consistent due to the 0% floor rate and the indexing strategies that I just mentioned. See, this would have come in handy in some of the market crashes like 2000 or 2008. If you had all of your money just directly into the market, then you would have experienced a 40% drop in your account value by the end of that year. With an indexing strategy, you've got the 0% floor. So if you had $500,000 in the account before the year, then you'll have $500,000 in the account at the end of the year. And then you don't have to make up any of that lost time from losing 40% of your account. If it's directly in the market, your $500,000 would have looked like $300,000 at the end of the year, and you basically would have had to start from there to start clawing your way back. With the indexing strategy, you stay at the $500,000 and then you keep clawing your way up. Another reason for somebody to use this is that there's no maximums on how much you can fund like there is with a typical IRA or 401k. Obviously, there's the maximums that I mentioned before, but you can always just increase your death benefit and continue plowing money into it. The IRS just won't allow situations where maybe somebody takes out a $100,000 death benefit on themselves, but then funds it with $100,000 per year, then they're going to tax you. Always increase the death benefit to get around that. Not only are there no maximums on how much you can fund it per year, but you can also withdraw it before your normal retirement age. See, if you have your money in an IRA or a 401k, you have to wait until you're 59 and a half years old. With this, you can withdraw it whenever you choose. This would make it really popular with the FIRE community, Financial Independence Retire Early. Now, since we're talking about withdrawing money from this, let's talk about the smart way to do that. If you want to pull money out of your cash value, you've got two choices. You can withdraw it, or you can borrow from it. Route 1 is withdrawing the money, which may be taxable to you once you've exceeded your basis in the policy, the money that you've paid in. We don't want to do that, obviously. We want to take a loan against the policy. Under the Internal Revenue Code, loans are tax-free, so we want to take a policy distribution in the form of a loan because the IRS says we can do that without paying any taxes. And when I say policy loan, I mean loan, because that loan is never going to be due and payable in your lifetime. That means you never have to pay it back. You can just borrow against your own money and never pay it back. The way these loans are structured is actually what allows you to take out 10 or 15% of the account value rather than the 4% that has been the rule of thumb for all these years. Now, when you take a loan from your cash value, the insurance company gives you the money tax-free because loans are not taxable, but they don't pull the money out of your account. The money stays in your account to participate in the market index and still earn you interest. They're not actually giving you your own money, they're giving you the insurance company's money and just collateralizing the loan with your cash value. Now, since that loan is not required to be paid back, in the event of your death, they would just subtract that value from the death benefit before they give it to your beneficiary. Now, if you were to pull money out of a normal retirement account, you're reducing your ability to earn returns in the market because you're reducing your exposure. With an IUL, you continue to earn interest on the money that you're taking as a loan because it stays in the market index and you keep the exposure. So as an example, let's say that I've got a retirement account with $1 million in it and I withdraw $100,000. Now my balance is $900,000 and let's say the market returns 10% that year. I would earn 10% of $900,000 and I would wind up with $990,000. Now, if I have $1 million in cash value in an IUL and I take $100,000 in the form of a policy loan, I still have $1 million of exposure. So when the market index returns 10%, I get credited $100,000 and my new balance is $1.1 million. $1.1 million minus my $100,000 loan is $1 million. If I had done that in the normal retirement account, I would wind up with $990,000 and I would have had to pay tax on the $100,000 I took as income. If you do this long enough, that's a situation where you can get into an arbitrage situation where the policy might actually be growing by more than you're withdrawing from it. That's why you're able to take 10 or 15% rather than 4%. Now, let's talk about some of the strategies for why somebody would want to structure a policy in this way. The idea in order to build the best cash value is to choose the lowest death benefit that the IRS will allow you and then fund it to the maximum to grow the cash value the most quickly. So many people will structure this policy in a way that the cash value grows the most aggressively, and they'll use that cash value to supplement their retirement income with tax-free dollars. Now, let's assume that you end up at retirement and you've got $1 million in a retirement account and then $1 million in cash value in an IUL. If the market goes on a big downturn in a given year in retirement, you don't want to be pulling money from your 401k because you're having to sell more shares to generate the same amount of income that you were previously. So you want to leave the money in your 401k and pull your income from the IUL so that you're not reducing the ability of the 401k to grow back to its previous value. Let's say that you have a child and you want to start planning for college. The normal ideas are a 529 savings plan or a Coverdell account. You can use an IUL to grow a college fund tax-free, and you're not limited by all the things that a 529 or a Coverdell are limited by. You can fund more money into it per year, and you can withdraw the money much more leniently once they get there. Now let's say you're into real estate. You can use your cash value to purchase a fixer-upper, renovate it, and then flip it for a profit. You just take a policy loan to buy the property and renovate it, and then you can repay it once you're done and the property is sold. Obviously, something like this provides a lot of flexibility and gives you more options in retirement, and really the name of the game in retirement is options. So if you made it to the end of the video, I appreciate you watching and hopefully you gained something of value from it. As always, drop any questions or comments you have below, and don't forget to like and subscribe for more content. Thank you guys, and I'll see you in the next one.